Objectives. At the end of the lecture, you must be able to explain spontaneous financing versus negotiated financing. 2. Explain the various types of spontaneous and negotiated financing. Accounts payable and accruals. Unsecured and unsecured loans. Analyze and compare the effective interest costs for different types of financing. Lecture outline. Introduction, spontaneous financing, accounts payable, accruals, negotiated financing, unsecured financing, line of credit, discounted loan, secured financing, accounts receivable financing, factoring accounts receivable, inventory financing. Financing costs, stated interest rate, effective interest rate. This is how a typical balance sheet look like. We are focusing only on the current liabilities or short-term financing. Introduction. What is the advantage of borrowing to invest? If the return from an investment exceed the cost of borrowing to finance that investment will increase a firm's profit. A simplified example. A piece of machinery which costs 150,000 to purchase will add 15,000 annually to profit. The cost of borrowing is 8% per annum. The return on investment is 15,000 divided by 150,000 is 10%. Should you borrow money to invest in the machinery? Answer: yes, because the return on investment, 10%, is more than the cost of borrowing, 8%. What's the risk of borrowing? Not being able to repay. Interest and principal. The borrower must make payment promptly when due. Interest and loan repayments are contractual payments. That means it must be signed by contract and is bound by the contract. So the borrower must, the loan and the interest and the loan repayment must be repaid on time, even if sales are bad or business is poor. Otherwise, will be sued for bankruptcy. Financing. Types of financing here. Short-term financings will be covered into this lecture. Intermediate terms financing will be covered later. And long-term financing will be covered in latest lecture. What is meant by short-term financing? Borrowings to meet the financial needs of a business within 1 year. The two sources of short-term financing are spontaneous source and negotiated source. Short-term financing is borrowing of less than 1 year. So look at the balance sheet here. We're focusing on the current liability side. Under current liabilities, you have accounts payable, basically borrowings from suppliers, accruals, borrowing from external parties, and negotiated short-term loans, borrowings from banks. The first two are spontaneous financing, and the bank loan is negotiated financing.